I think the markets kind of got oil wrong. The idea towards the end of last year was that there was going to be a big glut of oil on the global market in Q1, Q2 of 2025, and the International Energy Agency, the IEA, and other groups put out these. They put out these estimates every month showing this build in global crude oil inventories, even if OPEC plus maintains barrels off the global market. But I think there's a lot of problems with their estimates on the supply side of the equation. Uh, the most obvious is they're expecting or they're penciling in a lot of growth in US shale oil production in 2025. And the reality is that we really haven't seen growth in US shale oil production or US oil production generally in something like 18 months now. So if you look at the EIA's data, that's from the Department of Energy, US Department of Energy, you'll see that, oil production's really been flat for, a long time, and over 18 months. And there just isn't growth because, companies that are producing oil in a play like the Permian Basin, they're not going to grow oil production for any other reason than if the price permits them to do so. So, their costs are pretty simple. Shale is basically a manufacturing business, right?
Right.
You have a certain amount of acres in a play like the Permian Basin. The oil and natural gas and other hydrocarbons are widely distributed through that acreage, right? So producing more oil and gas and natural gas liquids is a function of spending more money on drilling and completing wells, which is capital spending, CapEx, which is the number one cost center for shale companies. They have costs related to maintaining older wells, of course, general administrative, all the stuff you have with a normal company, but their big lever, if you will, is CapEx. And obviously, they're willing to spend, if they spend more CapEx, they can grow their production, right? And they're willing to do that if the price is there. So if the price of oil is $90 a barrel, they want to spend a little more money and grow oil production, 5-6% maybe in the course of a year if they're a really good producer. But if oil is, in the 70s area, right, where it's been, or even lower, there's no incentive to do so. They would rather dial back their capital spending, um,
Mhm.
you know, cr- lower their costs, create more free cash flow, and leave that oil in the ground. Because their idea being that when oil prices are more attractive, they can accelerate their growth. All these producers have, by definition, right, a limited number of drilling spots, drilling locations. There are, of course, differences in quality between different drilling locations. So you have, um, you know, prime locations that are lower costs, and you have sort of secondary locations. But when a producer is looking to drill acreage, they only have so many spots they can go to. So there's certainly no reason in the world to run through those spots at a 65 or 70 or even $75 oil price. You're going to do that when oil price is 90, 95, or 100. So the idea that, is out there that, US oil production is going to grow suddenly in 2025, even though it hasn't for 18 months. And, oil prices are in the 70s, say, or even the 60s at one point, right? That's just pure fantasy. It's not going to happen. The other areas that, groups like IEA are showing growth, right? So you have Brazil, which makes some sense. You have Guyana in South America, which also makes sense because they lead a big project down in Guyana, that is being developed in phases, right? So we had Liza phase one, Liza phase two, et cetera. And each time they develop a new phase, oil production does go up. But then outside the United States, Canada, Brazil, and Guyana, right? They're showing something like 600,000 barrels a day of oil production growth, um, in non-OPEC countries outside those that I mentioned in 2025. That's ridiculous. These countries haven't shown real growth in oil production in like 20 years, since the early 2000s. So I don't think that I think the only reason that we would see a build in global oil inventories in Q1, Q2 is if demand were to sort of fall off a cliff, if you will. And yeah, that's certainly a possibility. But I don't see that happening absent a recession. In fact, I think the risk is on the other side. We have China, which has had very weak growth and demand lately because the Chinese economy isn't doing very well. But I mean, I think at some point, I mean, the Chinese government's already announced a bunch of stimulus. At some point, I think they announce even more because they can't afford to sit around and wait, watch their unemployment rate go up, watch their growth sort of crumble, watch deflation right take hold in China. They're going to want to stimulate growth, and whenever you stimulate growth, you're going to encourage more oil demand, natural gas demand, commodity demand, copper, everything else, right? Certainly, India is another area which has seen very strong growth. So I actually think the balance is a lot tighter than is commonly believed. At the same time, you've got if you look at futures market commitments, from the Commitment of Traders report and and reports of that nature for Brent, you'll see that speculative length in oil, there are people going along oil, speculators betting on higher oil prices, is near multi-year lows and coming off multi-year lows. And, so people are bearish towards oil. I mean, people are bearish towards commodities generally. Bank of America publishes a global fund manager survey every month. And, they were showing that commitments to commodities generally among global asset managers that they surveyed is as low as it's been since 2017, I believe, the summer of 2017. So, obviously not very bullish towards commodities in general and oil also in particular. That says to me, well, you've got people underinvested in oil, not betting on higher prices, yet the actual fundamentals are a lot better than, I think is commonly believed, and potentially much better. So I think you see oil prices generally, you got a lot of people out there projecting oil prices to be kind of flat to down this year. I think it's more likely to be higher and sort of towards the upper end of the range we've seen in recent years. I would suspect that we'll see $90 a barrel oil this year at some point, probably before the middle of the year. The only thing that could bar that, I guess, is a global recession or a big. But right now, I think we're seeing kind of the opposite. And not just here in the U.S., but we're seeing something like a cyclical recovery in places like Europe as well. Um, and of course, as I mentioned, China. So I'm actually pretty constructive on oil. I think natural gas maybe has more opportunities for investors, but I don't think you should ignore, the oil side of the equation at all.
Yeah. So you brought up a lot of things, and it seems like the contrarian play. Correct me if I'm wrong right now, because there is a lot of negative sentiment.
Right.
Correct me if I'm wrong. Um, the next thing that you mentioned, you talked about the Permian Basin.
Hmm.
What's your thoughts on that? Actually, I'm not talking peak oil running out of oil, but that is, and again, I want your thoughts on this. That is plateauing, or it's being projected to plateau in the next really pretty soon in the next few years. And then what? Where are companies going to go to get the production to meet the demand, if you would?
Yeah, I think that that's a sort of an intermediate to longer term issue that will probably be crucial to the next wave of what I think is a multi-year super cycle in oil. And that is just the idea that, there's still this idea in the back of people's minds, having lived through the shale boom years, that, the US can produce as much oil as it wants, just has to go out and drill. And, to an extent, that's true. As I mentioned, if you increase CapEx, you'll probably increase oil production. But I think we're closer to a plateau level than is commonly believed. I like to think of it as, producers running on a treadmill, right? So they have to spend a certain amount of capital, right, to drill new wells just to offset declining production from existing ones. If they want to grow production, they have to run a little faster to keep it, above the speed of the treadmill. If they cut capex, they can increase their free cash flow near term, but ultimately that decline rate is going to catch up with them, and their production is going to start coming off. So they have to drill through their inventory of drilling locations over time just to maintain oil production. They have to drill through it faster, shorten the amount of inventory they have, if you will, in terms of years of drilling inventory, if they want to increase production. And so I think you're going to see a lot of producers and most of the big ones, right? Because it's increasingly consolidated in the hands of a few big players. You've got majors like Exxon and Chevron. You've got the large independents like the Diamondbacks of the world, Occidentals of the world. You don't have as many small producers out there. There are a few, but a lot of the private ones too have gotten bought up here in the last year. So, a lot of these big companies look at it as you know slow but steady growth in production when years are good, kind of flat production, maybe a little decline in production when prices are not favorable, and just slowly develop their inventory. They have no desire to drill through it in 5 years. They would rather have that cash flow kind of come in over time as prices warrant it. So I think what you're going to see is a plateau. So it's not going to be big surge and then drop, right? It's going to be more of like we get up to a level and we kind of hang around there. And when commodity prices are a little higher, maybe you see a little bit of growth to the top of that range of production. When commodity prices are lower, you see a little bit of a decline, but we're a lot closer to that plateau than I think the market commonly believes. If we're not already there, I think, we're probably within 500,000 barrels a day or something like that, rather than, another 2 or 3 million barrels a day of production upside near term. Um, and you're also seeing it in individual company results. One name, that strikes me as important to watch is a name like Devon, right? Devon Energy. And they produce a lot of, one of their biggest operating area is the western portion of the Permian, which we call the Delaware Basin. So wells in the Delaware Basin tend to be gassier, right? They have more gas and natural gas liquids content. But what we've been seeing is Devon drills through its inventory, their amount of oil they're producing as a percentage of total output from their wells is declining. And wells are becoming gassier and natural gas liquids more rich, natural gas liquidy, whatever you want to call it. And obviously those hydrocarbons aren't oil. And so I think that's an issue as well. As these companies drill through their inventory, especially in places like the Delaware Basin, will we see oil production grow at anything like the rate of overall production growth, right? So barrels of oil equivalent coming out of the ground, which includes natural gas liquids, all of that will grow and has been growing, but the actual barrels of oil growth, the actual oil, is growing at a far slower pace. And that's an issue as well. In terms of, where do we go from here? Well, there isn't another Permian Basin in the United States, right? You have, the Permian Basin, the Delaware Basin, and the Midland Basin. These are, these are going to be your best plays in the United States in terms of shale. And there really isn't another play of that size out there. Yes, there are some other plays out there which will continue to contribute, like the Bakken Shale, for example, but they're not going to show anything like the growth, probably seeing declining production already in many cases. You have sort of some second tier plays like the Scoop Stack in Oklahoma, for example. It's a very nice, profitable play, a little higher cost structure. But again, it's going to be hard to show growth out of the Scoop Stack without growth from, or without at least steady production from the Permian. It's going to be hard to push overall oil growth. Outside the United States, there are a few promising plays like Guyana. I mentioned Exxon's project there. Not many years ago, they were getting in 2020, 2021, they were getting attacked by this, activist fund who did not like that they were investing so much capital in oil exploration and development. And they wanted to divert capital to, alternative energy. And, that was a bad idea. That would have been a bad idea. Fortunately, Exxon continued to invest in Guyana, and it's turned into this world-class play that's extremely profitable even at low oil prices. But again, there are not many other plays out there like that. OPEC does have some spare capacity, particularly, Saudi Arabia, some of the other big Gulf countries do. But again, it, even though it sounds like a lot, say, Saudi Arabia has 2 million barrels a day of spare capacity. I don't even think it's that much, but let's just say, it doesn't take the world very long to run through that if production from other countries is falling off. And Saudi Arabia, is going to struggle to grow its capacity to produce oil without massive investment over the next few years. So yeah, I think the answer to your question is there really isn't anything that can offset, um, an outright decline in production from the United States, and really even just a flattening of production from the U.S., where the U.S. continues to produce at sort of this 13.5 million barrel a day area. You know, that still has challenges because you have to have, if you have overall growth worldwide in demand, which I think you do for decades to come, honestly, um, it's going to be difficult to meet that demand with the US flat. The US shale has basically enabled all this growth and demand globally over the last 10 years. And if that is sort of petering out, not petering out, but plateauing for a long period, it could be, I mean, it could be 20 years plateau. It's not an immediate decline, I'm saying, but that has obviously an impact on prices. Prices have to be much higher to incent companies to go out and drill in these more expensive plays.